Hi, welcome to Market in a Minute. So we get inflation this week, a couple of inflation reports. We think the reports are going to be fairly mild, and we think that trend's going to continue as we go through 2026. So we see kind of a double barrel blast for the markets. What we mean by that is that we have the fiscal policies baked in. So those are there, and we're going to see some of that come through as we go through 2026. But the monetary policy as well could be much better than expected. So we could see interest rates drop more than expected. So we could see that acceleration, those cyclical groups that have started to perform even better as we go through 2026. To start with, we want to talk about the stock market, how it's set up. And we talked about this quite a bit, that last year was a year of change. And boy, was it, right? We saw the markets decline roughly 19% during the first part of the year, spooked about the tariffs. Now the tariffs are in place. We're starting to see some impact from it. We're seeing the impact of some fiscal policies. And the cyclical parts of the economy are starting to improve. So we're seeing a rotation occur in the latter part of last year, that a rotation occur, and we think that that rotation could accelerate. So thinking about how the market's set up. So we went back and we talked about this as well before, but I just want to reiterate. We went back and looked at, the returns, double-digit returns. We had 3 double-digit returns in a row now. And historically, we've only had it occur 4 double-digit returns 3 times. We had one that was 5 years in a row. That was in the 90s. So we have a little bit of a history of 4 in a row, once at 5 in a row. But I think this all sets up to be more similar to the 1980s. And I'm going to go through that in detail. I think you'll be surprised at how similar things are now versus the 1980s. But 1982 through 1986, you had 1 year there that was below 10%. So the economy has a good foundation currently. The fiscal policy is in place with lower taxes, incentives of property, plant, equipment, incentives to buy cars as well, right? So all sorts of incentives in place. The tariffs in place to bring back manufacturing to the U.S., more production, i.e. lower cost of goods over time. And so we like the more efficient government programs that we're doing, making the government more efficient, taking out the fraud, lower energy prices, so pro-energy production, and then just in general, lower regulations should help the economy quite a bit. On the monetary policy side, again, we think that we're going to see lower inflation, and we could see rates down much lower than where they are now. If inflation comes in below 2%, boy, I tell you, that's a big benefit to getting lower rates and really getting the economy more productive. The stock market's still highly valued. We all know that, 22 times earnings for the S&P 500. But below that, things look really interesting. So there's been stocks or sectors of the market that have been totally left behind, that have not performed very well, that are attractively valued, and under this scenario could perform extremely well. So on the fiscal policy side, things are baked in, but the monetary policy side is not. We need lower inflation. So there's an economist, Larry Kudlow. You've probably seen him on TV quite a bit. I followed him way back in the day when he was at Bear Stearns. I like him a lot, smart guy. He thinks we're going to see negative inflation prints. If we see negative inflation prints, it's usually bullish for the markets. So why would we get negative inflation prints? Because oil prices are down considerably. Gasoline prices are now in some areas below $2. Amazing, right? That has a big impact on everything that we buy. In addition to that, as we go through this year, we're going to see finally the lower rents come through, or the flattening of rents come through, to see lower housing prices. So that could have a big impact as well. So we have energy and housing together. That's a very large part of CPI. So the sentiment of the market, it's bullish. but it's not overly bullish. So we want to keep it the way it is. So a little bit of concern around, but not overheat. So this week, I'll be running around the JP Morgan conference with my analysts. We're going to see probably upwards of 30 different companies that we've selected to have one-on-one meetings with. And we're going to walk away with some really good ideas there. There's certain areas of the market, like pancreatic cancer, that are really hot, and that we want to get in front of those companies that have good prospects. So we're going to have some good ideas. We're going to update everybody next week of what we discovered. Inflation reports this week. So the expectations is for 2.7% year-over-year growth and 0.3% month-to-month. So you can see this trend here. This is the impact of tariffs, I believe, up 0.4 and up 0.3. So we might see the month-over-month rate come down quite a bit. Here is the year-over-year trend. So this is November. Now we didn't have October, so you had from September to November a big drop. So again, October wasn't in place because of the government shutdown, but you see this massive drop from one reporting period to another. So we think that inflation is on its way down to probably in the low 2% area, which again would be really positive for the stock market. The GDP growth, frankly, I can't believe these numbers, but GDP now does a good job. They have a volatile indicator. We had consensus down at roughly 1%, and they're saying that the GDP report could be, for the fourth quarter, it could be 5%. That's unreal. So that may or may not happen, but we do see a big uptrend in growth occurring in 2026. So this year we're going to see a nice acceleration of GDP growth, and again, that's going to have that impact of getting the rotation of these stocks that have started to move, getting that double barrel blast to them. Now the valuations. As we mentioned, the S&P 500 over and over again is highly valued at roughly 22 times earnings. Here's the S&P right here. It's gotten in its history, to 25 times. That was in the late 90s and 2000, roughly 22 times. So if everything occurs as we see it, maybe we do see some multiple expansion. But it's been in roughly the past 5 years is 15 to 25 times. So at 22, it's kind of in the upper end of the range. If we see, some really negative news hit, we could come down to 15 times. So we could see a really nasty correction, if not bear market, if some negative news hits. So we have to be aware of that. But you look at the small cap stocks. Small cap, okay, it's been left behind because the economy has not been good. It's all been growth in artificial intelligence build out. So 12 times earnings been the low for the small cap 600 index. And historically, it's been as high as 20 times earnings. So we think that at 15 times, it could go to 20 times. And you could see that big growth of 20 to 30% earnings growth occur. You could see that area of the market up 50%, say, over an 18-month period. So 20 to 30% earnings growth. If these policies hit, lower interest rates plus good fiscal policy, 20 times earnings for small caps are very possible. Now, I like to be, prudent. Just because I think this something could occur doesn't mean it will. And so if we get a correction, I tell you what, I want to own those stocks. The 1980s, okay? So more and more I think about this. We don't have the same things in place as we did in the 90s. So everybody's thinking tech bubble. Yeah, we do have a tech bubble, okay? It's too big of a portion of a weighting in the S&P 500 because the stocks have done well. So the S&P 500 has roughly 48% in tech and tech related. Crazy. So it just tells you that the rest of the market has lagged, and maybe that the rest of the market's going to catch up. So what's similar to the 1980s is that Reagan's policies and Trump's policies look so much alike. The same mind frame is in place. I think Larry Kudlow must have designed these Trump policies as he did it with Reagan. But anyhow, same policies in place or similar policies. And then in the 1980s, inflation peaked and inflation came down. We're seeing that now. Inflation has peaked and inflation is coming down. We see that trend continuing. So from 1982 to 1989, you had really good returns in the stock market. You had 1 year that was atrocious from the high to the low, but in general, that was a great decade. Similar in terms of the power it had in the late 90s. So look at this: 1982, 21.6% appreciation for the S&P 500. 83, 22.6. 84, okay, below 10%. So that could happen this year. 6.4% increase for the S&P 500 in 84. We had a bear market in tech, really nasty bear market in tech. Remember the semiconductor came out and that was a new thing, right? Big new thing. Lots of companies went public. Kind of reminds me of now. 1985, 31.7. 1986, 18.7. 1987 was a crazy positive year until we had this one-day bear market. So we had a big year. Could that happen again this year? Absolutely. We could have a very, very strong year. I think it might torture all the bears, and then it could break. So it'd be great to be tactical. Now look at the returns per year. So 21 all the way through the 90s, really good returns. 2 years of not double digit, but good returns, and then boom, a recession in 1990. So it does remind me a lot in the 1980s. Good returns, but with volatility to it. And so if these policies are going to work, if they're in place, lower inflation, better monetary policy, fantastic fiscal policies. So the two combined, it's very similar to the 1980s. The investor sentiment. So I don't think the market's waking up to this yet. 42% of the market is bullish. That's a big improvement. That's over 30% that's bearish. We were wildly negative back in April of last year at almost 62% bearish. And so that's kind of resolved itself with that nice move up in the market. People are more bullish. So I don't think that the sentiment is so positive that's a negative at this point yet. Did you see last week where Mobileye acquired a humanoid robot company? So they have the autonomous driving technology. Now they have the human robots, and those robots will be coming out probably next year. So it reminds me a lot of Tesla. We have a little mini me in Mobileye. I like that company a lot. I like what they're doing. Obviously, they're much smaller, and they're not going to be the big winner Tesla is, but they could certainly perform really strongly and be an acquisition target at some point. So we were pretty aggressive on buying that stock last week, the week before, at around $10 a share, and now it's 11. I think that could go up nicely over time. Lots going on in the healthcare space. As I mentioned, biotech was up last week. We had great performance as well. We're looking for some of our ideas to really kick in. Anavex, I think, is probably AVXL, one of the most undervalued companies out there, a little bit misunderstood, with a really good drug for Alzheimer's, but also schizophrenia and Parkinson's. You're going to see a lot of news come out on this Parkinson's drug too. So I think the stock, next week will be treated really well at the JP Morgan conference. And then we're out looking at things next week in the pancreatic cancer area. That's a hot area, and I think gene editing is coming back. But the pancreatic cancer area, big unmet need there, and we're going to meet with some companies that are focused on that. So lots of opportunities. We love the housing space. We want to get more invested in that area of the markets and the cyclicals in general, and we're cyclical stocks in general. But we're going to pick things off and and do it smartly. So tactical management should outperform this year versus a buy and hold approach, because we do see volatility coming. When the volatility hits, we need to protect ourselves and then take advantage of it. So our tactical strategies at PVG are really good. Come to the PVG website, check those out, right? And then come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute, and we'll send that to you every week. So again, we'll talk to you next week after the JP Morgan events, and should have some really interesting ideas. Take care.